What does a government do when its debt becomes too large to reduce normally? But default is not an option? In earlier videos, we saw how different money systems shape how economies deal with inflation, rising debt, and global trade imbalances. Under rigid hard money systems, discipline was automatic. Money supply was limited, and imbalances forced quick correction. Modern economies chose a more flexible system instead. Fiat money allows governments, banks, and financial institutions to expand credit, refinance debt, and absorb shocks over time. That flexibility made it possible to sustain inflation, growing debt structures, and even long-lasting global imbalances. But flexibility does not remove the underlying constraints. When debt becomes very large, when financial relationships grow sensitive, and when markets become uncertain, governments eventually face a difficult problem. If cutting spending is too risky, if raising taxes is too slow, and if default is not acceptable, how do they actually reduce the burden of debt? In theory, reducing large government debt sounds straightforward. A government could cut spending, raise taxes, or repay its obligations directly over time. But in practice, each of these options carries serious risks for economic stability and political trust. Large spending cuts can weaken state capacity, disrupt public services, and strain welfare systems that many households and institutions already depend on. Rapid tax increases can slow investment, reduce economic activity, and, if pushed too far, begin to erode confidence in the predictability of the system itself. As we saw in earlier discussions about institutional stability and social coordination, once trust in economic rules weakens, adjustment can become much harder and more disruptive. And outright default can damage financial credibility, destabilize banks, and sharply raise future borrowing costs. Because of these constraints, highly indebted governments rarely rely on one dramatic solution. Instead, they often turn to slower, more indirect ways of managing the burden. These approaches do not eliminate debt immediately. Instead, they gradually reshape how interest rates, savings, investment flows, and financial institutions interact with government borrowing. In many cases, the adjustment happens quietly through the structure of the financial system itself, rather than through visible fiscal decisions alone. In many cases, these indirect methods are collectively known as financial repression. The term does not refer to a single policy. It describes a set of tools that shape how the financial system channels savings, investment, and borrowing in ways that make government debt easier to sustain over time. The word repression can sound as if it describes one group deliberately suppressing another, but structurally, it does not refer to direct control over individuals. Instead, it describes how the financial system can be arranged so that certain types of assets, particularly safe savings instruments, deliver lower real returns over time. This means the adjustment does not fall evenly across society. Borrowers may benefit from easier debt conditions, while savers, fixed-income investors, and institutions holding regulated portfolios may gradually bear more of the burden. Financial repression, in this sense, is less about who is actively repressing whom, and more about how the structure of the financial system redistributes costs across balance sheets over time. One common element is the environment of borrowing costs. When interest rates remain relatively low compared to economic growth or inflation, the real burden of existing debt becomes easier to manage and refinance. Another important element involves the structure of financial regulation itself. Modern financial systems require banks, pension funds, insurance companies, and other large institutions to hold significant amounts of assets classified as safe and liquid. In most regulatory frameworks, government bonds fall into this category. Because these institutions must comply with portfolio, liquidity, and solvency requirements, large pools of savings naturally flow into sovereign debt markets as part of their regulated asset structure. This does not usually operate through direct instructions to finance government borrowing. Instead, the allocation follows from how assets are classified within risk rules, liquidity frameworks, and capital requirements. Once those definitions are in place, the flow of institutional savings tends to follow automatically. As a result, government borrowing becomes structurally supported by the regulatory architecture of the financial system itself. Governments may also influence savings incentives, banking rules, and capital conditions in ways that encourage funds to remain within the domestic financial system rather than moving freely abroad. None of these measures usually eliminate debt on their own, but together, they gradually shape the environment in which debt is financed, refinanced, and absorbed by the broader financial system. Over time, this can reduce the effective pressure of large debt burdens without requiring immediate default, extreme tax increases, or abrupt spending cuts. Before we continue, if you think this is valuable, please it helps share it with others. Subscribe so we stay informed together. When financial repression operates over long periods, its effects rarely appear as one dramatic event. Instead, the adjustment unfolds gradually through changes in returns, incentives, and financial choices across the economy. For governments, the immediate effect is greater stability in refinancing debt. Borrowing costs remain more predictable, demand for sovereign bonds stays steady, and fiscal pressures become easier to manage over time. But this stability does not remove the cost. It shifts how that cost is distributed. When safe savings instruments deliver lower real returns, households holding cash savings, fixed income products, or conservative pension allocations may see their purchasing power grow more slowly than expected. Financial institutions required to hold large amounts of regulated assets may also face reduced portfolio flexibility, limiting their ability to pursue higher return opportunities elsewhere. At the same time, borrowers, including governments, corporations, and households with existing debt, benefit from more manageable interest conditions and refinancing environments. Over time, this creates a quiet redistribution effect. Resources gradually move from holders of financial savings toward borrowers whose obligations become easier to sustain in real terms. Because this adjustment happens slowly through interest rates, portfolio structures, and inflation interactions, it rarely appears as a single visible policy decision. Instead, it becomes embedded in the normal functioning of the financial system itself. Financial repression is not unique to any one country or period. Over the past century, similar financial arrangements have appeared repeatedly in situations where governments carried very large debt burdens and needed time to stabilize their fiscal position. Historically, such environments often emerged after major wars, financial crises, or long periods of heavy public borrowing, when reducing debt quickly through taxation or spending cuts would have risked destabilizing the broader economy. As long as economic growth continued, financial markets remained broadly stable, and public confidence in the system held, these arrangements could persist for many years. But their stability always depended on balance. If growth weakened for extended periods, if inflation became unpredictable, or if savers and institutions began to seek alternatives outside the regulated financial structure, maintaining this balance could become more difficult. In this sense, financial repression is not a permanent solution. It is a stabilizing phase that can extend the adjustment period of large debt structures while the broader economy gradually adapts. Financial repression is rarely introduced through a single announcement or dramatic policy change. More often, it emerges gradually through shifts in financial rules, regulatory frameworks, and monetary conditions that reshape how savings and borrowing interact across the economy. This means that understanding the concept is only the first step. The more practical question is how to recognize when such a phase may be developing. So where does your own country currently stand, and what are the signals to watch? Watch for signals such as prolonged periods in which interest rates remain low relative to inflation or economic growth, financial regulations that increasingly favor sovereign bonds as the primary safe assets for institutional portfolios, banking, pension, or insurance rules that tie large pools of savings to regulated domestic financial markets, policy measures that encourage domestic investment in government debt or reduce incentives for capital to move freely abroad, and public discussions that increasingly frame financial stability and debt sustainability as priorities over market flexibility. None of these signals alone defines financial repression, but taken together, they can indicate how governments manage large debt structures through the architecture of the financial system itself. In the next episode, we examine how capital controls fit into this broader toolkit, and how restrictions on financial movement can further shape the relationship between savings, debt, and state stability. Financial repression is part of TNBC Explainers Module 3, Economy, Money, and Financial Power. Explore the TNBC Explainers course via the YouTube course list or visit thenextbigcycle.world for the full course overview and background. This is The Next Big Cycle. TNBC Explainers, your guide to understanding the systems shaping the world around you. TNBC Explainers is a growing YouTube course. New concepts are added over time,